Good morning, everybody, and welcome to this August edition of our monthly sustainability webinars. Now, in Melbourne, we are still in the midst of winter. I can't believe it's 1 September on Monday. The weather doesn't give us any clues that it's about to be spring. I also know that many of our regular attendees are in the midst of an audit, finalizing 30 June 2025 reports, trying to work with the auditors to get those audited financials lodged. So we are thinking of all of you. Good luck. I know the large listed entities usually aim for end of August or maybe end of September, and then privates end of October. So it's a busy time, and therefore thank you very much for taking time out of your busy calendar to join us for this webinar. And if you're watching this recording, thank you again for taking the time to watch the recording. Maybe if you watch the recording, it will be after busy season, but thank you nevertheless, and welcome. So my name is Aletta Boshoff. I'm the national leader at BDO for IFRS and corporate reporting, so normal IFRS accounting standards, but also sustainability reporting. BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community, and we pay our respect to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. As you know, we've got our monthly sustainability webinars. The focus in 2025 on AASB S2. I should also flag that I think 2 weeks ago, Kevin Frobers, Al Nahal and I went to Sydney to attend training presented by the Deputy Chair of the International Sustainability Standards Board, on invitation or in conjunction with the Australian Accounting Standards Board. It was 2 full days of training on IFRS S2, the foundation, but then also an Australian perspective on how it's slightly different for AASB S2. So it was great for us to hear from the standard setter globally, also the Australian standard setter, and we aim to bring some of those learnings and weave it into our publications and our webinars. We went with the purpose of sitting there and trying to pick up, did we do something wrong in earlier webinars? Did we advise clients maybe down the wrong path? And we were very happy to walk away and say, no, we've got it. We're on the right path, we're on the right track, so all good. But it's always good to hear how somebody else articulates it. It's fantastic to hear how standard setters have thought about the standard, and we'll try and weave that into future webinars as well. As you know, for 9 years now, Kevin Frobers and I have been doing monthly IFRS and corporate reporting webinars. Our next one in September is the tricks and traps of impairment testing. An interesting connection between impairment testing and what we do in AASB S2, because as you know, in AASB S2, we talk about financial modeling. We model the impact of climate-related risk and opportunities on the current period and anticipated effects, and we also consider it in scenario analysis. And often when we speak to clients, we ask them, what do you currently use for impairment testing for financial reporting purposes? What models do you already have in place? And therefore we can use that as a foundation to add functionalities, maybe add additional years looking in future, because for sustainability it's short, medium and long term, which is open-ended. But ultimately we start with your existing impairment testing model. And therefore that might be an interesting webinar on what should the existing impairment testing model look like, and how do we then, in some of our sustainability webinars, consider how do we uplift and improve that for the purposes of for AASB S2. And then also a call out to the 22 October webinar, where we're looking at accounting for Australian carbon credits. So that's the debits and the credits in the actual financial statements. Now, more or less the same time, in our sustainability webinars, we will look at the disclosures around carbon credits. So again, you can see there's that link between what we do in financial statements and what we do in sustainability reporting, and we try and cover both angles through our webinars, and they are connected. Now, next Wednesday is our next carbon accounting virtual masterclass. I'm very excited that we have a large number of registrations already. But if you are interested in carbon accounting, in particular, the measurement of your greenhouse gas emissions, and we'll explore a great number of complexities during the day. We've got 26 case studies that we try and deal with in the session, and we're always adding more case studies as we go. Please feel free to reach out. It would be fantastic if you could join us. So registration link is there, and you can see that the next one is Wednesday, the 3rd of September. We've also got one the 3rd of December, and we've scheduled ones for next year as well. A reminder that we've got our AASB S2 climate-related disclosure checklist. Thank you for those of you that's contacted me with feedback, positive feedback, but if you've got suggestions for improvement also, feel free to reach out. As you know, we look at the 4 pillars, and today in the webinar we actually focus on pillar 4. And there's also a 5th pillar for general requirements that is carried forward from AASB S1 to the extent it's relevant to climate-related disclosures. We help you with a rating scale. We help you with specific disclosures and also a summary of those specific disclosures. Now, before we kick off for our August webinar, I thought I'll do a shout out to our July webinar. In our July webinar, we pivoted. It was supposed to be a focus on Pillar 3 risk management, but we did deal with that quite extensively in the June webinar. And therefore in July, I took a bit of creative license or freedom and actually changed the July webinar to focus on materiality around sustainability reporting disclosures. And that was because most of the questions we've recently heard from clients were around materiality and how you apply that within AASB S2 mandatory sustainability reporting. There's a whole webinar to watch, and I would really advise you to watch that. Again, thank you for the feedback on that one. It all came down to the following, and this is a high-level summary, but I think gives you a good flavor. And that is, when you look at materiality in AASB S2, you fall back on what we apply when we use IFRS accounting standards. The IFRS Foundation have issued a number of years ago a practice statement 2, on the judgments around materiality for financial reporting for IFRS accounting standards. The International Sustainability Standards Board have recently published educational material, and at the start of that educational material, they flag that they've built their educational material for the application to IFRS S2 and therefore also AASB S2 on that exact practice statement. So we use the same practice statement for materiality as the foundation for IFRS accounting standards and IFRS sustainability disclosure standards. Interestingly, when we went to Sue Lloyd's training in Sydney, materiality was the one thing that I wanted to confirm, that we nailed that webinar because it was very fresh in my mind and recent. And, she made very similar comments. To a degree, it looked as if we were speaking exactly from the same hymn book. So that was a good confirmation. So if we bring it back to AASB S2, I call it a Part A and a Part B. Part A, if you look at AASB S2, you do a climate risk and opportunity assessment. And you assess whether a climate-related risk or a climate-related opportunity, and we use the following words, could reasonably be expected to affect the entity's prospects. So what do we mean by prospects? The entity's cash flows, the entity's access to finance, the entity's cost of capital, and they also add a time frame over the short, medium, or long term. But in shorthand, throughout the standard it is whether a climate-related risk or opportunity could reasonably be expected to affect an entity's prospects. So that's the terminology we use. What you can see here in Part A, we don't refer to material risks or opportunities. We don't refer to significant risk or opportunities. We consider whether a risk or opportunity could reasonably be expected to affect an entity's prospects. No mention of materiality. So I think it's important that we get our language right. A lot of people try and apply a materiality lens in Part A, and that's not appropriate. So it's about prospects, reasonably expected to affect an entity's prospects. And if you assess that a climate-related risk or opportunity could reasonably be expected to affect the entity's prospects, if you have a yes assessment, you then go to Part B, and now we have to identify and disclose material information. So materiality is applied to the information we would potentially disclose. The words in the standard, we now assess whether information about a sustainability-related or climate-related risk or opportunity would need to be provided by an entity to meet the requirements set out, and that's disclosure requirements set out in AASB S2. Right, so we apply materiality to the information. We don't apply materiality to that initial potential risk assessment or opportunity assessment. And there's two things here to think about this, how we consider materiality to information. First of all, could the information reasonably be expected to influence the decisions that primary users make on the basis of general purpose financial reports? So primary users, investors, financiers, potential investors, financiers, and assess whether omitting, misstating, or obscuring information could reasonably be expected to influence the decisions primary users make about providing resources to the entity. It was interesting that when we attended that training in Sydney, Sue also talked about that second one. You know, if I omit this information, if I misstate this information, if I obscure the information, you know, would that influence decisions? So it's kind of a negative assessment around consideration around materiality. So this is very high level. We expand on this. We explain this in great detail in the July webinar. I highly recommend that webinar. Now, if we move on to the next webinars in our series on AASB S2, you'll see on Pillar 4, which deals with metrics and targets, we've actually scheduled 3 webinars over the 3 months, August, September, and October. So interestingly, 3 hours, 3 months on AASB S2 metrics and targets. So today we have a particular focus on measuring or tracking your carbon footprint or your greenhouse gas emissions. It's very much linked to our carbon accounting masterclass. So really today I'm just giving you a high level helicopter flyover And in the Carbon Accounting Masterclass next week, Wednesday, we do a deep dive with case studies, and it's very practical. But today, I'm trying to link carbon footprint also back to the actual standard. Then in September, we're going to look at setting and tracking climate targets. And we're going to look at other climate metrics. So I just want to make it very clear. Measuring your greenhouse gas emissions is one of the metrics that one could use to look at climate-related risk and opportunities. There are others, and we will flag that and give you some ideas in next month's webinar what those other metrics could be fit for purpose for your business. And then we also talk about targets. And targets, again, is not only limited to your greenhouse gas emissions. There could be other targets that help you to address climate-related risks or explore opportunities. And then in the October webinar, we look at carbon credits. Now, that is particularly relevant for entities that are subject to the safeguard mechanism in Australia, but also other businesses that have set targets and have to disclose progress towards meeting those targets and whether they would need carbon credits. So in this webinar, we're looking at the sustainability reporting side of carbon credits. And in the October IFRS and corporate reporting webinar, we look at the accounting for these carbon credits in your financial statement. So they go hand in hand. So today we start just with greenhouse gas emissions. Before we look at that, a bit of an introduction to Pillar 4 around metrics and targets. Always good to stand back and say, so what's the objective of these disclosures? It's climate-related financial disclosures because we are addressing disclosures to primary users, investors, financiers, and it is financial disclosures around metrics and targets. And the objective is outlined in paragraph 27. The objective of climate-related financial disclosures on metrics and targets is to enable users of general purpose financial reports. And by the way, users of general purpose financial reports are defined as primary users, investors, financiers, both current and future. So what are the metrics and targets that we have to disclose to enable those primary users to understand three things about the entity at a very high level? The entity's performance in relation to climate-related risk and opportunities. Remember, the whole AASB S2 is around climate-related risk and opportunities. That's why that's always the starting point. So how is the entity performing in relation to climate-related risk and opportunities? Also, what is the entity's progress towards any climate-related target it has set? It's not talking about only greenhouse gas emission targets. Any climate-related target that an organization has set, how are we progressing towards those? Often businesses would identify, packaging and packaging materials as part of a climate-related risk, opportunity, and therefore they set targets. If you've set targets around those packaging aspects, it's part of a climate-related target, and you have to disclose that as well as your progress towards meeting that. And then the third one, progress towards any targets that an entity has set to meet the requirements by law or regulation. And again, there's a potential interaction with the safeguard mechanism, because if you don't meet certain regulatory targets set by the safeguard mechanism, you have to buy carbon credits, etc. So it's very broad. It's broad, your performance around climate-related risks and opportunities, climate-related targets, not just greenhouse gas emission targets, and then also a target that's required by a law or regulation. Again, just want to flag, it's not only the safeguard mechanism. There could be laws and regulations imposed on businesses around packaging materials, which is linked to climate, and therefore those targets should also be disclosed and your progress. So this is much broader than just greenhouse gas emissions. So that's the first thing. The second thing, sorry, I have this irritating cough, and hopefully a little sip of coffee will help me. I should show all of you, look at this beautiful cup. My mum and I went away over the weekend to a regional area, Bairnsdale in Victoria, and we went to a lovely breakfast and a shop, and I saw this beautiful cup. So it's obviously green, so it matches sustainability, little flowers to match the sustainability, and my favorite color. So hopefully no more coughing, because I've got coffee from my new favorite green cup. So what is the objective of climate-related financial disclosures on metrics and targets? Now, in this particular case, they say, listen, to achieve the objective outlined on the previous slide, an entity shall disclose the following. First of all, information relevant to cross-industry metric categories. And they explain that further in paragraphs 29 to 31. And we'll pivot back to that in next month's webinar. So first of all, cross-industry metric categories. They also want targets set by the entity. So by the way, they're not forcing businesses to set targets, but if you've set a target, you have to disclose that target. So this is a target that you've set to mitigate or adapt to climate-related risks or take advantage of climate-related opportunities. Also, any targets that's required to meet your law or regulation, and metrics used by the governance body or management to measure progress towards these targets. So you can see this slide is just expanding on the overall objective. There's an objective, and now we say in order to achieve that objective, these are the kind of things to think about. Very important, this last one. Any metrics, not just targets, metrics used by the governance body or the board or the Audit and Risk Committee or management, the executive, the leadership, to measure progress towards targets. Then if we look at the objective, it was interesting. IFRS S2 has a slightly different objective than AASB S2. And I wanted to put them side by side here so you could see the difference. IFRS S2, we talk about across industry metrics. They talk about industry-based metrics, and they talk about specific requirements for climate-related targets. And they say this includes disclosure of greenhouse gas emissions. And by the way, that also applies to AASB S2, the greenhouse gas emissions. But you could see at a high level, AASB S2 does not require the disclosure of industry-based metrics. When the IFRS S2 looks at industry-based metrics, they refer to the AASB standards for industry-based metrics. In Australia, the Australian Accounting Standards Board decided to not mandate those industry-based metrics. Interesting, and I take this point that Sue Lloyd made at our training in Sydney. However, if a business wants to think, what are appropriate metrics and targets for my business? I'm on a learning journey. I'm on a continuous improvement journey. Why not go and look at the AASB guidance on industry-based metrics? Because that would give you some idea of the things to think about that's relevant for your industry. It's not mandated in Australia, but it gives you some good food for thought. And I think that's a good approach. Also, you might think, so what's cross-industry metrics? What is industry-based metrics? What's the difference? Cross-industry metrics represent a standardized set of measurements applicable across all industries. So they've tried in paragraphs 29 to 31 come up with cross-industry metrics in order to say these are the things we think all businesses that apply AASB S2, IFRS S2 should disclose. It gets us to comparability. So that is cross-industry metrics. And then in Australia, we don't have to look at industry-specific metrics, but you're always free to do that as you develop this. Moving on to, and sorry, just go back to the slide. In red, I've put specific requirements for climate-related targets, includes disclosure of greenhouse gas emissions. I mean, you cannot have a greenhouse gas emission, a target on a greenhouse gas emission if you don't disclose the underlying greenhouse gas emission as a starting point, as a baseline. And that's how we come back to our webinar today and our masterclasses. The starting point is always measuring your baseline. Because if you know what your baseline greenhouse gas emissions is, then you can engage with your board, with executive leaders, with management to think what would be an appropriate target. Obviously, you consider the broader world view, the world, in particular in Australia, what is the Australian government committing to, and how do we contribute to that as an Australian business? So really important to consider all of that. Have a baseline, have an idea what the Australian government is doing, what is happening at a global level, and then what is an appropriate target. So if somebody discloses a target, but they don't disclose their baseline, personally, I'm quite suspicious. You know, how did you come up with a target without a baseline? And remember, if you disclose a target, you need a plan to realistically be able to achieve that target. Otherwise, it could be seen as greenwashing, because we can put up fancy targets that we've got no way of ever achieving, and that would not be appropriate. So be careful of that as well. So if we go back to measuring our baseline greenhouse gas emissions, maybe first of all, an overview of greenhouse gas emissions. A few pointers here. First of all, when we look at greenhouse gases, we are measuring 7 greenhouse gases, and you can see them in the circles at the top. We express all of them after we've done our calculations in terms of a carbon dioxide equivalent. They've not all been created equally, so we have to apply global warming potentials. But those are the 7 greenhouse gases that we measure. Make sure from a completeness perspective you've considered all 7. If you look at your greenhouse gases, and we'll discuss this a bit later, we've got our Scope 1 direct emissions. We've got our Scope 2 indirect emissions, and that is purchased electricity within Australia. Globally, it could be purchase steam, purchase heating or cooling. We've got upstream emissions, so all the emissions that happen before goods and services arrive at our gate, and downstream emissions, all the emissions that are incurred by our customers as goods and services leave our gates. So you can see, if you look at greenhouse gas emissions, we have a cradle to grave assessment of greenhouse gas emissions. So it's really important to look at the whole value chain. Now, BDO's approach to measuring your greenhouse gas emissions, we've developed globally, being led by Australia, a BDO carbon accounting methodology, and that is the methodology that we step through in our carbon accounting masterclasses. This is just a few screenshots from that methodology to give you a bit of a taster of what we're looking at. Now, in our approach, we came up with a 10-step approach. I want to make a few observations without looking at this in detail at this stage. First of all, you can see that In step 8, we look at applying a calculation tool. Only in step 8. So many businesses that I speak to are trying to fix their carbon accounting measurement problem by buying technology. And the focus is on technology. Now, in my view, technology has a very important role to play at the appropriate stage. There's a lot of work that have to happen before you select a technology solution. And as you conduct steps 1 to 7, it would inform your decision making on what would be an appropriate technology solution. And by the way, in the Carbon Accounting Masterclass next week, I've got our preferred technology provider coming in to do a demonstration of the tool that we use when we do these calculations, but also something that you can engage with them directly to use. So many technology providers out there, so just be very careful. High level, number one, please ask if it's a black box. If it's a black box, don't go close to it. We need assurance. We need to know if we give them data, what do they do with our data in order to get to a carbon footprint? If we can't see exactly what they've done, emission factors applied, where they got the emission factors, assurance would be a big problem. So I think that's important. The other thing is also to consider, when you use technology, if you put rubbish data in, you're going to get a rubbish number, carbon footprint out. And so for us, a big focus in our carbon accounting masterclass is how do we assure accurate and complete data going into our technology solution? And some solutions have some functionality to assist with that. So that's my first thing. Technology is step 8. The other thing I want to talk about is, if you look at the bottom, I've got a little gray block that runs across step 1 to step 7, and it's called prepare a basis of preparation. Embedded in that basis of preparation is we've got a boundary setting policy. So some clients have a boundary setting policy, and then they have a separate basis of preparation. Some people have it combined in one document. Doesn't matter. Critically important that you have a basis of preparation. Critically important that you deal with a boundary setting aspects, which is step 2 and 3. So all your judgments, your decisions, your estimates in a basis of preparation. Again, many clients would give us a number, and then we say, oh, this is a number out of a black box, not useful. So let's get the number without a black box. Show us a calculation, show us completeness of data. But actually, the starting point is, what is your basis of preparation? How did you assess your boundary? Are we happy that your basis of preparation not only complies with the Greenhouse Gas Protocol, in Australia complies with National Greenhouse and Energy Reporting Scheme, the NGES scheme, and applies with the requirements of AASB S2, which really adds another level to the Greenhouse Gas Protocol and to NGES. So that basis of preparation and a thoroughly prepared basis of preparation is critical. For us, when I work with the auditors and we go in, I would say, please give me your boundary setting policy. Then please give me the rest of your basis of preparation across scopes 1 to 3, everything. Then show me how you've assessed completeness of your data. Then show me the calculation, whether it's an Excel or a fancy tool. And then we, can look at processes, systems, other assurance aspects. So really important to get those things right. So you can see the basis of preparation is steps 1 to 7. Only in step 8 do we have a tool. I will quickly flag some of these steps, but those were some initial observations. I look through the various steps. Now in the masterclass, we step through this in great detail, but I'll give you a bit of a flavor of it, trying to point out most of the common mistakes that we see in practice. So step 1 is determine if the disclosure of your greenhouse gas emissions is mandatory or voluntary. And there's a very important reason for this, because if you are preparing your carbon footprint on a voluntary basis for a voluntary sustainability report, or wherever you want to put it, on your website, or to provide it to suppliers, for example, you would usually say, I'm doing it voluntarily. I'm going to use the greenhouse gas protocol. The greenhouse gas protocol has a lot of optionality in it. So it's got a minimum aspect that you have to calculate. And then optionally, you can include other things. So if you do it on a voluntary basis, you can make use of the optionalities within the greenhouse gas protocol. The best example of that is the greenhouse gas protocol actually says all downstream emissions, so scope 3 downstream emissions, category 9 to 15, are optional, recommended but optional. So if you are preparing a carbon footprint on a voluntary basis, you could use that and disclose that you've used it. However, if you are preparing your carbon footprint for mandatory reporting, you have to consider what are the mandatory reporting requirements. AASB S2 is saying that we have to consider the whole value chain. That means cradle to grave. That means upstream, downstream, absolutely everything. It also says we have to consider materiality across all these different categories. So a lot of people are making judgments as they go on and say, oh, I'm not going to pick up, let's say, hotel accommodation as part of my category 8 carbon footprint. It's not category 8, business travel category 6. But you can't make that assessment. You have to first do the calculation and prove that that hotel accommodation is not material. Consider it with all your other data. So be careful to make a materiality assessment too soon, because for mandatory reporting, we have to include everything, and we actually cannot use the optionality outlined in the greenhouse gas protocol. AASB S2 lifts the bar quite a bit higher. So I'll stop with that at the moment. Step 2 is look at your organizational boundary. Now, the greenhouse gas protocol sets 3 different approaches to organizational boundary. You could look at the equity share approach or the control approach, and the control approach has a financial control approach or an operational control approach. So there's 3 different approaches that you could use to set your organizational boundary. Now, again, the financial control approach would be based on IFRS accounting standards, IFRS 10. Equity share approach doesn't have a direct link to the financial statements, and operational control don't have a direct link. However, for assurance purposes, we try to contrast and compare what we do here with what we've done for financial reporting to make sure that we've considered everything and documented potential differences and reasons for differences. Another angle to consider is operational control is what is required by ENGA. So if you're doing ENGA, you're an ENGA reporter, it just makes sense for GHG protocol and AASB S2 stick to operational control. And I've given you some high level, what does it mean? What does equity share mean? And how does it impact your greenhouse gas accounting? We do some examples in the masterclass. Now, after you've set your organizational boundary, you go on to set an operational boundary, and that is, what are my direct emissions? So it's emissions from sources that are owned, controlled by the entity, as opposed to my indirect emissions. So emissions that's a consequence of operations of the reporting entity, but the actual emissions don't occur at sources owned or controlled by the company. Now, interestingly, indirect emissions are scope 2 and scope 3. Some people think the fact that we have to disclose scope 1 and scope 2 emissions initially under AASB S2 in the first year, means that Scope 2 is a direct emission. No, it's not. Scope 1 is a direct emission. Scope 2 is an indirect emission, but it's quite a special indirect emission because it's your purchased electricity. And in a way, you've got significant influence to decarbonize that purchased electricity. And therefore, we're starting with Scope 1 and Scope 2 because, from a decarbonization perspective, they are, I would say, easier to decarbonize than Scope 3 emissions. If you look at identifying your sources of emissions, the key thing here is we're looking at the whole value chain. So we're looking at the interactions, the activities, the resources, the relationships that an entity depends on to create or deliver its products or services from conception, cradle, to delivery, consumption, and end of life, the grave. So most entities have many different value chains. It's not just one value chain. So you can see how complicated this gets. It's your value chain, each and every value chain. So value chain emissions are emissions associated with upstream and downstream activities associated with the operations of our reporting entity. So it's important that we can map all our emission sources across our reporting entity or group in order to calculate that entity or group's carbon footprint. Again, completeness, really important. Now, we also talk through, how do you identify sources of emissions? This is, again, a bit of a completeness worry. Have we picked up all the greenhouse gases? Have we picked up all the sources of emissions? So mapping the value chain, really important. Understand your operations cradle to grave. And that's why I think, it's really important that you work with people within your business. If you're in the finance team, you should understand the operations, but also go and work with the people on the ground, understanding the operations and understanding that actual value chain. So where do all our purchases, purchase goods and services, where do they come from? Who are all our suppliers? Look at all the products and services that we offer to customers. Right, so if you work back from the products and services we provide to customers, somewhere we have to get those products and services from. So there has to be suppliers, or we manufacture it. So that's another thing to consider. And then you also have to consider all your financial interests that you hold in investments. It could be franchise relationships. It could be loans that you provide. So important to look at that as well. And then step 3, you categorize and come up with the categories that these emissions fall into. So categorize it into scopes and subcategories. Then in step 5, we determine the emissions that should be included in our calculation. Now here I want to say a word of caution. The Greenhouse Gas Protocol refers to screening. So you look at all these categories and all these sources of emissions and all these activities, and you consider, based on screening in inverted commas, which of this should be included in your carbon footprint measurement. And they say you consider qualitative factors and quantitative factors. Now, screening is a concept in the Greenhouse Gas Protocol. If you are looking at AASB S2, we look at materiality. And therefore, it's a higher bar. It's a more extensive process. We don't rely on a loosely defined screening in the Greenhouse Gas Protocol. We look at a materiality-based assessment. So that's a word of warning. And for example, if you look at another difference, if we screen or do a materiality assessment across the greenhouse gas emissions, under AASB S2, you have to repeat that materiality assessment on occurrence of a significant event, or if there's a change in circumstances. So you don't have to do a materiality assessment or screening every year, but it has to be well documented when you've done it. For example, when you look at European sustainability reporting standards, they have to screen scope 1 and 2 every year and scope 3 at least every 3 years. So it's more strict. Now, the greenhouse gas protocol doesn't even have any of this. You just do a screening. They don't say when to necessarily repeat it. I would imagine if there's a change in circumstances. But remember, for us, we have to definitely consider occurrence of significant events, and we should do more than screen. We actually should prove that it's not material. It's similar to people saying, the fair value of a derivative for IFRS 9 is not material, and then the auditors would say, prove it to me. So actually determine the fair value of the derivative, and if I can see the number, we can assess whether it's material or not. So the same year, you have to measure absolutely everything and then consider and prove why certain things are potentially not material for disclosure purposes. Then if we look at step 6, select an appropriate calculation approach. Now, there are different potential calculation approaches. We could have a process-based approach. We could be in sophisticated businesses, industries. We could have direct measurement of data, so direct measurement of the methane released while mining, for example, and that gives you tons of emissions of methane. You apply a global warming potential to get it to a carbon dioxide equivalent. But most businesses actually use estimation at the bottom. So they use activity data, they apply an appropriate emissions factor, they come up their tons of emissions, they consider global warming potential, and they've got their tons of carbon dioxide equivalent. When you look at activity data, so you don't have direct measurement, you're not that sophisticated, but when you look at activity data, there's a hierarchy. There's primary data, then there's secondary data, and then there's absolute pure estimation. Can you see they indicate that primary data is the higher quality and estimation is the lower quality? But all of these are acceptable for measurement. The idea is to, over time, move from estimation, so potentially spend-based emissions, to primary data. So we try and improve data quality, accuracy, completeness. We try and use better estimation techniques. We improve that over time. And we prioritize improvement for activities and categories that have a relatively a low data quality, but they've got high emissions. So we look at the most material aspects or categories and improve that first. And then if we look at step 7, determining emissions factor, this is where technology can help you. Often AI could help with this. Obviously, if you use AI, always review it for appropriateness. But it's a factor that allows your emissions to be estimated from a unit of whatever available activity data you have. So it could be tons of fuel consumed, tons of product produced, and come up with an absolute GHG emission from that factor. So you identify factors at a lowest level for each emission stream. You select the most appropriate emissions factor for each of those streams. Very important to document key decisions in your basis for preparation. Now, earlier, I've talked extensively about applying a calculation tool because it's very important. Don't rush to a tool. Do your education, do your boundary setting, do your basis of prep, look at your data, accuracy, completeness, and then you consider an appropriate tool. We then in step 9 have to roll it up at a corporate level to report, and we report our emissions. So that gives you an idea of our methodology. It's a flyover. It's a methodology of I think about 200 pages when we delve into the details. If we move on and we look at our Scope 1 emissions and the measurement of these Scope 1 emissions, there are 4 categories of Scope 1 emissions: stationary combustion, process emissions, mobile combustion, and fugitive emissions. And I'm trying to here just give you a bit of an overview of what those are. So, for Scope 1, these are emissions as a result of the combustion of fuels in stationary equipment that's standing still, a boiler, a furnace, a turbine. Compare stationary combustion to a mobile combustion. It's still combustion of fuels, but it's combusted in company-owned mobile, movable combustion devices like vehicles, buses, trains. So stationary and mobile combustion, very similar. Process emissions, it is as a result of processing or manufacturing chemicals and materials, quite sophisticated, and we have to work with experts to measure those. And fugitive emissions is the result of intentional or unintentional releases of greenhouse gases that are not physically controlled. So it's equipment leases, for example. It comes from, releases from air conditioners, refrigerators. Now, Scope 2 emissions, there are 2 measurement methods that you can use in the greenhouse gas protocol: location-based method and market-based method. So location-based method is looking at an average energy generation emission factors for a specific location or geographic location. So there's a factor for Australia, there's a factor for different states in Australia, and for other countries we've got specific factors as well. So market-based method is where you look at the contracts that you've got in place, and maybe you've got a power purchase arrangement, etc., and how that would impact your Scope 2 emissions. So this is measurement. There's 2 methods. By the way, under AASB S2, we are mandated to disclose location-based method and included in the carbon footprint, and market-based method is an additional disclosure that's required. If we move on to Scope 3 emissions, what I've tried to do in the slides is I've looked at all 15 of these categories. So it's the upstream emissions, 8 categories. There's the downstream emissions. We've got 7 categories. Under AASB S2, the initial measurement and assessment of all 15 are required, and you have to look at each and every aspect of all 15, right? So you can't exclude things initially. You have to prove whether certain aspects are not material, and you could only do that once you've got your total carbon footprint. And then you can decide what is not material for disclosure. So we cannot exclude 10 different categories because they are all less than 5% of your footprint, because together, they could be 50% of your footprint. So you still look at materiality individually and in aggregate, and that's very important. So what I've tried to do here is give you a bit of a snapshot of all 15 categories. So I started with the upstream emission categories, and look at category 1. It's an interesting one. It's a residual category. If it's not fitting into category 2 to 8 of the upstream emissions, the catch-all category is category 1. And then therefore you have to look at categories 2 to 8 first, and then we circle back to category 1. Now in category 2, and for everything that you'll see here today, I've got a little bit of a snapshot from our BDO Global Carbon Accounting Methodology, a bit of a picture. And I'll just explain it once, and then you can have a look at it. So category 2 is capital goods. So the first question is, what emissions are included in this category? What's included in capital goods? So capital goods include, and we have to be careful on the words and read the words very carefully. It includes the extraction, the production, and transportation, please underline transportation, of capital goods purchased or acquired by the company in the reporting year. So it's only things that we've purchased in the reporting year. But it's trying to pick up the emissions associated with the extraction, the production, the transportation of all the assets, fixed assets in your financial statements, property, plant and equipment, intangible assets, investment properties, buildings, cars. All those emissions are captured in your carbon footprint in the year that you buy it. So you don't have a concept of depreciation here. It comes in all at once in the year that you buy these assets. And it's not just emissions when you use the asset. No. It's extraction, production, transportation to get that capital good to your business. I flagged transportation because there's another two categories dealing with transportation. There's a category 4 and a category 9 dealing with transportation. But it's transportation of your goods and your services, so your inventory. If it's transportation around capital goods, it actually fits into the capital goods category. And now the question is, do you capture that separately in your general ledger? So looking at what's actually included is very important. On the right-hand side, we have minimum boundaries. Now, if you are doing voluntary measurement, the minimum boundaries is relevant to you because you can stick to that and you don't have to look at other things. If you are using AASB S2, the minimum boundary is just the starting point, and then you have to add emissions from that green block, emissions that may be applicable. Now, for capital goods, the minimum boundary is a complete boundary, so it's not a problem. But on other slides, you'll see there's additional things that we have to consider in those blocks. The last thing on the right-hand side that I include is it gives you a conceptual view on when these emissions actually occurred. So it could be when you buy a vehicle today, it's in the reporting year, it goes in your capital goods part of your carbon footprint. It could be that the extraction of the materials that was used for that vehicle was extracted 10 years ago. It could be that that vehicle was produced 2 years ago. It could be that the transportation of that vehicle, happened, last year, right? All of these things could happen, but it's still part of your category 2 capital goods in the current year. And some of those emissions could have happened in the current year. So conceptually, it's looking at the past. It's emissions that happened in the past in the value chain from cradle to current year. In this category, we're not looking at future years. Some other categories I've included, I've ticked that because in that category, you take an estimate and a stab of what it would look like in the future. So that's just a bit of an overview of what this diagram is trying to do for all the different categories. So what you'll see here, I've got category 3, I've got category 8, there's the transportation one. It's a difficult one. There's that tension between, is it category 4, is it category 9? We've got category 5, which is waste, similar diagram. We've got business travel, similar, employee commuting, and it also includes working from home these days. Thank you, COVID. And then category 8, upstream leased assets. So if you are a lessee, you're also looking at the emissions of a lessor. Then if you look at, we circle back to category 1. Downstream emissions, it's optional for voluntary reporting. It's mandatory for mandatory sustainability reporting. We come back to category 9, transportation, distribution of sold products. We have category 10, potential processing of your sold products by an intermediate party. We have the use of the sold product by the end customer, those emissions part of your carbon footprint. We've got end-of-life treatment of sold products, part of your carbon footprint. We also have category 13. This is where you're a lessor. You have to pick up emissions from the lessee as they use your particular asset that you've made available to them. And then we've got franchises. You have to pick up, if you're a franchisor, you have to pick up emissions of the franchisee. And the last category, investments, if you're an investor, you have to pick up, or if you provide loans, you have to pick up the emissions that you financed. And that's quite a difficult exercise again. So our BDO can help. We can help you to measure your carbon footprint. We can help you with mandatory or voluntary sustainability reporting. Obviously, we can look at strategy and assurance, a bit of an overview of our services, and we have regular newsletters. Sustainability news for August is coming out tomorrow. Please take note, there's an article on materiality and how it applies to sustainability reporting. My time is up, so I would have to say thank you very much for joining me. If this has raised some questions and you want to know more, please feel free to reach out to me. Please attend our Carbon Accounting Masterclass next week. And remember, next month, we look at the broader disclosure requirements around Pillar 4, metrics and targets. Today was very much about the measurement. Next time, in the next 2 months, it's about the actual disclosures. Thank you very much for joining today.